NVIDIA has always been a popular stock for traders, and in this video we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should buy the stock. As the market is still very volatile at the moment, we should be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. NVIDIA is one of the most popular stocks to be traded in Nasdaq and one of the most recognizable brands around the world. Its products are used in millions or tens of millions of devices around the world, and their quality is one of the most solid in the sector. The future economy will rely more and more on semiconductors and microchips, both of which NVIDIA has a major stake in. Its stock price has always been bullish over the past few years, and in the last 24 months, it went in the absolutely turbo overdrive mode, ultimately having a major correction that lasts till this day. If you're watching this video, chances are you want to find out about whether the bears are behind us and that the bulls are coming back. I think that from a fundamental perspective, no one is contesting the idea that NVIDIA is a great company. It has very useful products for the economy of today and of tomorrow. The company is also undergoing a massive change in its business model, for which it's been talking about and preparing for years. And that is the switch from hardware economy to an increasingly virtual working environment. It wasn't that long ago where each and every computer user had to have a physical computer at home, and they all needed powerful microchips in order to power more performant equipments. Nowadays, though, a lot of users can simply log in from a web portal to access a virtual work environment that's sitting in a server room. Of course, the server equipment would still need things that NVIDIA or other companies like NVIDIA provides, but we should not underestimate the potential sea change in the switch. Another aspect has more to do with the price action of NVIDIA stock price. It's difficult to argue that a company's value would have almost doubled when the world economy went through a very fragile episode. It can be largely explained by the capital flight into the tech sector back in 2020, but even with that in mind, we have to expect that a very significant correction would happen at some point to balance things back to a new equilibrium. Now, let's also take a look at the technicals of NVIDIA. The trading volume has been recently around 26 million shares versus the average volume of 52 million shares. Over the previous 52-week period, its price fluctuated between $140.55 and $346.47. The trading volume is a metric telling you how many shares are being exchanging hands. It also tells us about the activity and the attention on the stock. We can also use it to compare with the average volume, telling us if the company is enjoying additional momentum to reverse the trend or to break through the current resistance. Even when the current volume is lower than the average, it is an interesting indication because it may signify that a trend reversal could happen soon. The market cap of NVIDIA is currently around $380 billion versus an enterprise value of $462 billion. Simply put, the market cap is the fair market value the company has based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for the assets after paying off the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies might be the intangibles, meaning they're not items or stocks that a company could use to generate income, but secondary items providing growth potentials for the future, such as pledges, schematics, intellectual properties, and brandings. For startups, most of their valuations are based on those intangibles, which could be valued in more favorable market terms. What this means is that there could be a huge difference between the market cap and the enterprise value, giving a false impression to the market participants that a company is trading at a discount. It's only trading below the book value, but this doesn't mean that a company itself is necessarily undervalued. It could also mean that a company itself was overvalued in the first place, and that it has deflated back to where it's supposed to be. As we compare the current price to the historical price fluctuations, the stock is 7.3% higher than the 1-month low, 7.3% higher than the 3-month low, and 7.3% higher than the 52-week low. On the options market, which gives us a hint about the market sentiment, the implied volatility is 58% versus a historical volatility of 60%. The put-call volume ratio is currently around 0.63. It's normal for most stocks to also tend to have a higher put option volume than what they truly deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 355,000 contracts a day versus the 30-day average of 450,000. In terms of open interest, the most recent volume of open interest has been 2.5 million contracts versus the 30-day average of 2.6 million contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price, buying the contract giving you the right, and selling the contract giving you the premiums, with the obligation to execute the contract if the counterparty chooses to do so. It is often said that you could evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there's a lot of put options, there could be a possible uptrend on the move, or that a reversal might happen if there are a lot of call options. The reasoning behind the theory is very simple, as most options tend to expire worthless. In terms of shareholder structure, institutional shareholders own 70% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and Invesco. It is relevant to understand the shareholder composition of a company, as this helps to determine whether you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. There's a lot of exceptions to this, since many titles could also be held by retail investors and they're still great companies, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit. The share price falls lower. Sometimes there could be significant short interest in the total volume, resulting in an organized operation going on, such as what happened with GameStop and AMC. The current short interest is about 1.3% of the total float, and 62% of those transactions are coming out from the dark pools. Usually, if the short interest is above 15% of the total volume and a significant portion of the short volume coming out of the dark pools, this could mean that there are institutional positions taken to short the stock, and that there would be potentials for a short squeeze. My recommendation is to keep a foot in NVIDIA, but to keep the vast majority of your allocation for later, as I do believe that the stock will keep correcting down in the short term. I would therefore recommend to commit a total of 5 to 8% of your portfolio in NVIDIA, and would also recommend to split the allocation in batches of 20% at a time so that you could purchase more in case it retraces further. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally, that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.